Hey everybody, it's Ben and Greg back with the video that we promised earlier about some financial information that can help run your business. We hope you've had a great week so far celebrating with us our 4th anniversary. As you know, accountants really like to party,
Oh yeah.
so it's been over the top. We'll go ahead and what we'd like to do is show you a sample report that you get back after you submit your information to Mazuma every month in your purple envelopes. We process it quickly, we get it back to you, and so we want to show you the information that you can gather from that report and how it could be beneficial to your business. So we'll go ahead and start looking through that.
Yeah, so here's a profit and loss statement, an example of a new company Greg and I started. And as you can see here, we've got this cost of goods sold section broken out, and then all the other regular expenses down here. And whether you break out the cost of goods sold or leave it in with the other expenses is not so important, but identifying the difference between cost of goods sold type expenses and all of your other expenses is important. So what is a cost of goods sold type expense? It's also called a variable expense, meaning that expense varies with sales. So as your sales go up, these expenses are going to track up as well. Now the rest of the expenses aren't, or they may step up a little bit over time or be such a small increase that we would call them just fixed expenses, where they're essentially static. They're essentially going to stay the same no matter how much we sell. So with that, let's move into how we analyze these numbers a little bit.
Quickly, you can see we have the cost of goods sold section broken out here. Before we get into the analysis, just wanted to show you another example of how that information may be showing up in your current reports. The same information, again, just highlighted, it's just all captured in the expense report, but again, we would consider that part of the cost of goods sold. If your report currently looks like this and you'd like it broken out different, let us know here at Mazuma, and we'd be glad to modify your report. So getting into the analysis portion of it.
Yeah, so here in this graph, and here's the numbers behind the graph, we're showing the same numbers that were on the report. We had $80,000 of revenue, $60,000 cost of goods sold, $94.50 of other expenses, and a $10.5 net profit. When you divide the cost of goods sold into revenue, it's 75% in our first year. So for every dollar we make in sales, we spend 75 cents on payroll and other cost of goods sold variable expenses. And we know that we didn't get into business to make $10,000, right? So we need that cost of goods sold ratio to go down. And so we, as owners of the business, we would discuss, figure out ways to be more efficient, or maybe negotiate with our vendors to get better prices. Anything we can do to get that cost of goods sold down is going to increase our profit. And that's what is illustrated here by this graph. We start out with lower revenue, lower net profit. Our cost of goods sold is 75% of our revenue. But as you can see, as the cost of goods sold goes down to 70% of the revenue, 63% of the revenue, 60%, and 55% is our goal for cost of goods sold in 2019. So as you can see, as we meet that goal, we have a bigger span between revenue and cost of goods sold, and the difference is almost going all directly to our bottom line.
Right. So as consequently, you see the net profit increasing and the gap narrowing here between your cost of goods sold and your net profit, which is the ultimate goal.
That's right.
So anyway, again, that's some way to analyze the reports is focus on those numbers, help you to get more money in your pocket at the end of the day. That's the intent of the report, and that's what we're here to help you do. And so any questions, anything else that we can help further clarify for you, we'd be more than happy to do it. Just give us a call or shoot us an email here at Mazuma. Thanks again, and appreciate the 4 years so far.
Thank you.